Coming up in today's show, stocks rally to new year-to-date highs as we get the lowest inflation reading in 2 years, leading the market to hope that the Fed is near the end of their tightening cycle. And with some economists saying we can now avoid a recession. And that lower inflation sent bond yields and the dollar down, which then sent gold and oil higher as well. Welcome back to the Click Capital Daily Show, everybody. My name's Jared, and I'm going to break down all the most important news, data, and charts from the markets for you today. And it looks like the markets had it right yesterday. As I said, they were pricing in a better than expected inflation print, and that's exactly what we got today. With headline inflation coming in 3% year over year versus 3.1% expected, and that gave us a nice rally in the tech, especially the semis, which popped up today with NVDA leading 3.5%, and also gave us a bit of weakness in the healthcare and industrial space. So that lower than expected June CPI report has given more weight to a soft landing scenario for the economy, and it's got traders hoping that the Fed's only got one more hike left in the bag, and it's even making some economists say there will be no landing scenario, with former PIMCO chief economist saying that latest CPI report paves the way for the US economy to avoid recession altogether. He said this is what the Fed has been looking for and this is what the market wants to see. And the way the stock market has been rallying, it's obvious investors think the Fed has won the war against inflation. And that's why we're seeing that FOMO spill over from tech to the rest of the stock market, with improving breadth also causing valuations in the rest of the market to become a little elevated. And when you look at yield gaps comparing dividend yield to bond yield, all developed markets are now trading less attractive than their 20-year average apart from Japan. However, if it feels like your food bill's still going up more than 3% per year, you're right, because grocery prices were 5.7% higher in June compared to a year ago, and dining out was 7.7% more expensive. And just looking at some other categories within the inflation report, we can see housing's up 6.3% year over year. Personal care products are up 6.5%. Rent's up 7.9%. But what's really helped inflation is energy, down 16.7%. And we can see that in the weekly of crude oil futures, because a year ago we were trading a bit above $105 a barrel. Now we're just at $75 a barrel. And that's recently just bounced off the mid-60s. And we can see in the weekly chart of agricultural commodities, a year ago we're trading around $20 a unit in the DBA ETF, and we're about 6% higher now and in an uptrend. So back to the weekly chart of crude. So for inflation to continue its downtrend, we really need crude to continue its downtrend, because oil is a major input into a lot of things, not just energy, but in a lot of the products that we consume as well. However, we do have the Biden administration committing to refill the Strategic Petroleum Reserve, and OPEC want oil back above $80 a barrel. And we may see a big stimulus program out of China as well that could increase commodity demand. But no doubt this strong downtrend from crude, which peaked out a bit above 120 a little over a year ago, that has helped inflation a lot right there. However, it's not all rosy out there. We've still got JP Morgan CEO Jamie Dimon predicts consumers will exhaust their pandemic savings by Christmas, and he's warning of much greater threats than the recession. He's far more concerned about global threats like the Russia-Ukraine war, nuclear blackmail, and disruption to key supply chains. We've also had former Treasury Secretary Larry Summers said US deficits are on an unsustainable trajectory. He said, "I don't think there's ever been a moment when the trajectory looks nearly as ominous as it does now." And so that's true. The government and the consumer does have a lot of debt, and a big part of the rally we've had after COVID was the government and the consumer bringing their future spending forward, and unprecedented levels of stimulus and central bank liquidity hitting the system. And so the government and the consumers kind of blowing out their debt levels now. And the government at least has committed to reducing their spending. And it'll just be a matter of time before the consumer is as well, with their record levels, credit card debt, $1 trillion, and outstanding balances with record high rates as well. And with that lower than expected inflation reading, increasing the chance the Fed's near the end of their hiking cycle, that's caused yields to drop and the demand for the dollar to drop as well, which broke through a key support level today. And we can see that on the daily chart here. There's big support zone we've been watching for a while, around 101.50. Clean broke through it today, and we're just sitting above 100 now on the dollar index as I speak. And just taking you out to a weekly chart here, you can see this is a level we've bounced off. And so it looks like this downtrend started in October last year, looks to be confirming more to the downside. And that week, a dollar put a good bid in the gold market with some good price action on above average volume, sending the price of gold futures back above their 50-day VWAP for the first time since early May to 1961 an ounce. And I'm a gold bull, and I think we'll be hitting new all-time highs above 2100 an ounce any week now. Lower dollar also helped the price of crude rip higher, and now getting into almost short-term overbought territory just below 76 a barrel. However, that lower dollar didn't help Bitcoin as well, still stuck in this consolidation zone just above 30,000 a coin. But overall, commodities like that, we can see that in the commodity index fund DBC, close to pushing up to multi-month highs here and look to have really found support in this big support zone. So even though CPI came in a little lower than expected, the market is still giving a 92% chance the Fed will hike in a couple of weeks. I mentioned yesterday they decreased the probability that we'll get that second hike in September. Now currently standing at 14.7% chance that'll happen. That was down from 20% yesterday. So the market's assigning a 78% chance that the Fed is done. And it looks like the market saw that coming. As I mentioned yesterday, the 2-year government bond yield had been pulling back a bit, and we got down to 471 today, and even a bit of a reversal pattern in the 10-year government bond as well. So those lower yields helped bond prices move up. We can see that in the TLT ETF today. It's found support here in this zone that I've had drawn in. And just taking you out to a 3-month chart of TLT, it's actually had the biggest pullback in over 20 years since it's been on the market, almost 50%, as the Fed went on its most aggressive hiking cycle ever to combat inflation. However, if the market is right and the Fed is only going to do one more hike, then TLT could be at an attractive level here to add as a hedge as part of a diversified portfolio, because if the Fed does one more hike later this month, then indicates they're going to pause and likely stay on pause until inflation does get closer to their 2% target, then that should help create a bit of a floor in TLT around 100 here. And then when they do eventually cut, that should cause TLT to rally back up, as the price of current high-yielding bonds will be worth more versus the new lower-yielding bonds. And also, if we get something bad and unexpected happen, that could cause a rally in long-dated treasuries as well, like we saw here in COVID. However, it's all really hard to say, to predict what inflation is going to be 6-12 months from now. Like we saw back in the 70s, it could wave higher again. May not just be on a straight linear path lower, and especially like I said before, if we see crude tick back up, that's going to add a lot of inflation pressures to the system, not just in the price of energy, but in the price of goods, transport, and a lot of other things as well. And so the market seems perpetually stuck in technical overbought territory, and we can see that in the Fear and Greed Index, still at a really elevated level of 80. And you can see even a month ago we were at 78. Options markets loving this action. Really busy day, almost 43 million contracts traded and 59% of them calls. But whilst retail traders continue to load up on calls, we're seeing dark pool traders pull back again now, with the DIX in bearish territory and creating this strong divergence in the market here. And corporate insiders seem to be on holiday. They haven't been doing a whole lot of trading, but still selling a little bit more than they're buying. Okay, back into the charts. And so we've got the S&P 500 breaking out to a new year-to-date high, and the NASDAQ as well actually broke up above this resistance zone I've been watching here. And just looking at the weekly chart, we can just see that price momentum is so strong. NASDAQ hasn't done so much as a pullback for at least a couple of months now. And we've also got the Dow Jones Industrial just sneaking out to new year-to-date highs by a few ticks today. However, we've still got the equal weight S&P 500 below its February 2nd high, as well as mid-caps just, and the Russell and micro-caps still haven't found new year-to-date highs. However, just looking at our market risk-on-off indicator, we can see the market is still well and truly in a risk-on mode, as it has been for a few months. And just turning on our trend candles indicator, we can see we are now in short-term uptrends on all indices. S&P 500, the equal weight S&P 500. The Nasdaq's been in a short-term uptrend since late January. The Nasdaq equal weight's been in an uptrend since November last year. We've also recently had the Dow Jones go into an uptrend, mid-caps, the Russell, and even micro-caps now. And just looking at our sector trends table, you can see it's only staples and healthcare, the defensive sectors of the market, that are in downtrends on most timeframes, showing that the market's really rotated into the growth sectors, away from the defensive sectors. And as indicated by all this green, there's a lot of uptrends out there. So this just reminds us, no matter how bad the macro and fundamental backdrop is, we've got to pay attention to the price action. And it's very hard to fight the market when there is these strong bullish momentum uptrends across the board out there. And we can see that in the international stock indices coming back to life a little bit. Here's Canada's TSX. UK FTSE having a bit of a bounce off these oversold levels. Same with the German DAX, we bounced off these oversold levels. Nikkei's holding up a bit. Aussie back above its 50-day VWAP, and same with the China 50 index as well. There's volatility absolutely diving up front with that low CPI, and the main VIX 30-day index back down to 13.5. Also got volatility risk premium coming out of the market. Still got bonds moving around a lot more than stocks, and the options market is still demanding a premium on those out-of-the-money put options. We've got short-term breadth really elevated here with 82% of stocks above the 20-day average. And medium-term breadth is broken out to new year-to-date highs with 83% of stocks above their 50-day average. But we still haven't broken out on the long-term time frame, with the amount of stocks above their 200-day average still below that February 2nd peak. But we did get a bit of a breakout in the amount of stocks making new highs today. 193 on the NYSE and 107 on the NASDAQ. And just taking you out to a weekly chart on the NYSE new highs, We can see that has been improving over the last couple of weeks, and same with the Nasdaq as well, but still not back to these roaring bull market levels. There's growth versus defensive sectors continuing to tick higher, same with high beta stocks. Growth versus value still ticking up, and small caps are still holding in there versus big caps. High yield bonds are coming back up to test multi-month highs, and over to stock sectors, green across the board with gold miners the winner today. Really strong price action here, more than double average volume, and we had been drifting down really softly these last couple of months. Looks to have found a really strong bid here today. Strong move up in home builders as well to new year-to-date highs. Regional banks still doing well, and would you believe it, because hardly no one ever talks about it, nor do you hear about it much in the media, but the Aerospace and Defense ETF ITA came within a whisker of all-time highs today, and that's been on a really good rally ever since the debt ceiling was lifted back here in early June. There were some worries that defense spending might be cut, but that was the only category that the government said they won't put a pause on spending levels. And so the ongoing proxy war with Russia and soon to be one with China over Taiwan is giving a strong tailwind to all the big military stocks as the government continues to funnel your taxpayer money into them. And there's a look at the defensive sectors. Healthcare back underneath its 50. Staples just kind of hanging in there, and we did get a little bump up in utilities today. There's a look at the price action of the largest asset manager in the world, BlackRock, which I like to use as an indicator for the health of the US stock market. And that actually broke out to multi-month highs today, and we've got earnings coming out of them on Friday. There's a look at Berkshire Hathaway, also breaking out to new year-to-date highs. And JP Morgan almost found $150 a share this morning. We've got earnings coming out of them tomorrow. There's a quick look at the mega cap techs. Apple, Microsoft still consolidating in the sideways. Little bump up in Google. Amazon close to highs. And it looks like we may be getting that breakout in NVDA that I talked about yesterday. So we can see here on our wave flow indicator that it's been coiling up in a really narrow range, and volatility is really cyclical. Goes from expansion to contraction into expansion. So we very well could see NVIDIA at $450 a share tomorrow. We got that bullish seasonality, and we ripped up today to just under $440 on above average volume. There's a look at Tesla. We gapped up but finished a little bit lower. We got earnings out of them next week, and the best performing mega cap tech of them all, Meta Platforms, ripping up today to finish on its highs at $309.40 on above average volume, as their latest app thread has been performing well with new signups. Over to the meme space and some mixed moves out there. We had been seeing some big rallies this last few days in the most shorted stocks out there, including one I've been talking about for the last week, Carvana. Another 9.3% today. At one point it was actually up 25% today at $44 a share. So we're looking a little bit technically overbought here on the daily time frame. On this big inverted hammer candle formation, and we can see on the DSI we're really overbought at 16.8. However, just taking you down to the hourly chart, the price action on this has been really nice. We can see here on our wave flow it bunched up, coiled up for a few sessions, then we got that nice breakout on Friday that I talked about on above average volume, and just went into a really nice multi-day uptrend. However, now might be looking a little stretch, and we can see this on this inverted hammer shooting star formation on the hourly chart here on a bearish 7 count, and on that big volume as well that we typically see at reversal spots. So we may get a little pullback here today. However, the pullback may not last long, as this has got a lot of strong bullish momentum in it. Similar story in Beyond Meat. Really strong price action today, above average volume, coming off a really low base, so this may still have some more legs in it as well. And there's a look at the regional banks and the big banks having a nice little rally into earnings starting later this week and next week. There's a look at our S&P 500 oscillator, closing up today at 58.8, almost back into overbought territory, and just showing once again that the market and sentiment is really strong. And we can even see that in the Russell and mid caps, and with the Dow breaking out just a new year-to-date high slightly today. So it looks like the market is really excited about the prospect that the Fed's only got one more hike left in the bag, and the stock market's kind of pricing in that we are not going to get a recession. And once again, this big divergence between the stock and bond market just exacerbates even further with this price action. And so the bond market, with record inverted yield curve, with how deep it is still pricing in a recession. And we've still got a lot of billionaires and CEOs, investment managers calling for it. However, we've got a lot of research analysts, economists, and traders saying that we're not going to get it. So this will pretty much be the big story for the rest of the year. And we'll be really looking for that Fed speak come out later this month, when they do probably hike. And then the market will be really looking for them to say, we're going to go on pause now, and then just wait and see if all our rate hikes play out through the economy and keep inflation on the downward path. But like I said, keep an eye on the price of crude for some clues on the path of inflation. And we've still got food prices increasing 5-6% year over year, with agricultural commodities still in an uptrend. And that wraps it up today. Thanks very much for sticking with me. Appreciate all your support of this channel, and I hope to see you back again tomorrow afternoon. Cheers.